Good afternoon, everyone. Thank you for joining us today. I'm very pleased to be joining with David Early from Nuwaru to present this webinar on tax considerations in M&A transactions. Thanks very much for making the time, and we hope that this will be informative and interesting for you all. As an introduction, my name's Stephen Groves. I'm Managing Director of Groves and Partners. We're a specialist advisory practice operating out of Sydney and Brisbane. As part of our firm, we provide three key service lines. Firstly, we give clients transaction advice when they're buying and selling businesses. As part of that, we provide commercial due diligence advice, negotiate transactions on behalf of clients, find acquisition opportunities for them, and complete business sales for them. We also are expert valuers of businesses, companies, shares, and intangible assets, where we do so for anything from restructures to litigation. And lastly, we provide expert specialist advisory services in a range of areas, including preparing companies for sale. David Early is joining with me today. David has quite an interesting and esteemed background. Starting out at PwC, David went on to become the head of tax at Deutsche Bank in APAC for 16 years, based out of Hong Kong. And he since then has returned to Australia and is one of the founders of Nuwaru. Nuwaru are a firm that specialises in providing corporate taxation and consulting. Their partners are mostly ex-corporates, many as heads of tax, and also ex-Big Four partners. They're specialists in this area and a really, really reliable resource for you if you've got clients or if you yourself are dealing with any specialist tax issues as part of M&A transactions. I'm going to go through and commence off today and talk about some key updates, firstly, so far as the M&A market goes, and then some high-level guidance for you on the structuring landscape for M&A transactions and how tax plays into that. Thereafter, we'll allow David to go in and do a deep dive into some of the specific taxation issues that come up, leaning on his experience in this area to provide some really interesting insights. The M&A mid-market is really where we play at Groves and Partners. So our expertise is in lower mid-market and mid-market transactions. And accordingly, that's the part of the market that we're really quite familiar with. It's also, in my view, the most interesting part of the M&A landscape because it involves both larger corporates that might be looking at transacting a division of their organisation, as well as smaller founder-led companies that are looking at divesting their entire businesses or buying other businesses to spur on growth. As part of that market, we've seen, as is reflective of the rest of the M&A market, a lot of really, really strong transaction activity throughout FY22 and even into FY23. We're continuing to see that roll on. There's the classic drivers, which everybody is hearing about in the news media, which include access to funding, which has been strong, both private funding and debt funding throughout the COVID period. However, we're seeing at the moment some pressure points hitting the transaction landscape as a whole, particularly driven by inflation and some concerns in the market as to what the future economic position will be in the next 6 months, 12 months and beyond. However, particularly in the mid-market, we find that it's useful to look at the micro level as opposed to the macro level. We think that macro trends are often a little bit misleading, particularly when we look at some industries that really run their own race and are seeing their own activity spur on quite well. Those industries, in our experience, that are seeing quite strong transaction activity at the moment are industries like civil, so civil construction and earthworks. There's been strong demand for plant and equipment assets, yellow goods, over the last 12 months to 18 months, and that demand is continuing, and it's actually spurring quite significant M&A activity in the civil space. A lot of those businesses do fall into the mid and lower mid-market bucket. We're also seeing quite strong continuing demand for logistics companies. Companies that are importing and dealing in the logistics space are doing quite well. That extends to wholesaling businesses too. A lot of those businesses have had really quite strong activity over the last couple of years, and accordingly, some larger players in those sectors are in very good positions so far as their balance sheets go, and accordingly are hunting out acquisition opportunities, and that trend is continuing. We're also seeing really strong continuing interest and M&A activity in mining services, as well as professional services in particular, and tech. Those industries are performing well. They tend to run their own race as opposed to fitting into the broader economy, and accordingly, the transaction appetite from buyers and sellers in those markets is still quite strong, and we're seeing a lot of activity in those spaces. But as I noted, we think that at the macro level, there will be some pressure points, rising interest rates, inflations, and certainly tougher regulations and supply chain pressures are likely to affect momentum at the macro level. We're also seeing a softening from cross-border transactions as well. This has been in place since for the last roughly year and a half. Some of the government restrictions around FIRB have slowed up cross-border activity, particularly in the lower mid-market, and we've seen that firsthand, how that's played out in softening some activity for some industries. But acquirers in particular, as part of all of this, are certainly becoming more and more sophisticated. They're certainly becoming more and more selective in approaching particular deals. They're certainly, in our experience, thinking more carefully about how particular transactions will fit well into their business or won't fit well into their business, and making purchasing or selling decisions based on those types of factors. The M&A structuring landscape, we're going to have a look now at how the structuring landscape impacts on taxation considerations. In our experience, transactions occur in a whole host of different structures, and I would expect that we would see some flavour of that in the market. I'm sure David's seen a lot more than us so far as the different structures that are possible. Some structures commonly known amongst accountants and lawyers and other professionals in the world are share sales, asset sales. Sometimes there's restructures that are included as part of negotiating those types of transactions as well. In our experience at the coalface of completing transactions on behalf of clients, the nature of how transactions are structured varies significantly depending on the nature of the business that's being transacted and the tax considerations. The nature of the business is really quite key and does drive what happens so far as a structuring decision for M&A transactions. For example, sometimes we act for clients that have a larger organisation and are looking at divesting a division of their broader business. In doing so, that normally lends itself to very particular types of structuring. It's normally more likely in those situations that those types of company sellers will need to entertain undertaking an asset sale, especially in light of circumstances where they might not have specialists, where they might not have divisional structuring in place with different entities set up to allow a share sale to be completed with respect to that particular division. That is quite common. A client of ours, going back about 12 months ago now, operated a telecommunications business in the healthcare sector. So it was a telehealth business. They had they were part of a larger not-for-profit group, and as part of that transaction, the group was a not-for-profit entity which controlled all the different business units of that organisation, one of which was this telehealth business. As part of that, we had no option but to go and do an asset sale of that particular business, but it did cause many practical issues in undertaking the transaction, not least of which included looking at transferring thousands of different telecommunications plans from one entity over to the acquiring entity. So there's these types of practical issues which come up, but sometimes they can't be avoided. The nature of the business also tends to drive the type of structure that's put into place for a transaction. For example, uh, we see some industries in particular where it is inevitable that the transaction will need to be a share sale purchase, regardless of what anybody else wants, because there are licenses that are tied to the proprietary limited company or the company in place, which mean that that company needs to be transacted as opposed to the assets of that company that operate the business. Some of those in security services is a good example, for example, where the nature of the business is such that the security services license is really tied to that company, and therefore the company needs to be transacted. But from a practical perspective as well, we find any business that is invoicing a significant volume of clients and running essentially credit accounts for a significant volume of clients, or for that matter, where they've got a recurring revenue model whereby they're debiting customers a certain amount of money as a fee every month. Those types of businesses, it becomes a practical mess to transact them in any way other than doing a share sale, because an asset sale will necessitate typically the notification of all customers so that those payment details can be changed to new bank facilities, and that's normally quite messy and causes a lot of headaches for both vendors and purchasers in completing transactions. The size of the business, though, as well, is a big component of what influences people as to how to structure transactions. As a general rule, the smaller the business, the more likely it is that people will feel comfortable doing an asset sale. But we tend to encourage our clients to look really, really acutely as to whether they should do a share sale, because oftentimes we find that the practical outcomes of doing share sales is just exceeds any of the downside risks that people may perceive in doing a share sale and therefore doing an asset sale. Share sales usually attract CGT, but not GST or stamp duty. But I'm going to let David go into a little bit more detail as to the tax components of transactions. Real property has an impact on whether stamp duty is going to be an issue or not. But once again, we'll let David go into some more detail on that matter. Importantly, though, in my experience, vendors and buyers should always aim to understand the tax consequences of a transaction, as that will really influence how they negotiate and structure the transaction. As part of this, we, particularly for vendors, so company sellers, if they start engaging with us in discussions about potentially selling a business or a company, we are normally quite blunt with them in advising them that they should undertake a pre-transaction tax review, a tax planning review as to what the outcomes will be of the transaction. As part of that, normally it's necessary to look at some indicative valuation guidance on what type of proceeds will likely come from the transaction and how that could potentially be structured based on how typical businesses similar to the subject business transact in the market. But it's quite integral for shareholders to have an early view as to what the potential tax outcomes could be. And it's worthwhile, in our experience, that they spend the time and the professional fees in doing that work properly, as it does have quite a significant impact on what the proceeds will be from the transaction. And on that basis, we think it's worthwhile to engage early with professional tax advisors to get that advice at the outset, so that it can be fundamental to the decision-making process that shareholders undertake in determining whether to proceed with completing a transaction or not, and also fundamental to the decision-making process that shareholders undertake when they're assessing offers made to buy their company, for example. Other tax consequences which may be considered as part of a transaction include cross-border tax issues. I touched on that a little bit in my last slide. Cross-border tax issues and cross-border transaction issues generally, we're seeing that that's for some industries in particular, it involves necessitates some prior work to investigate any concerns or issues that could come up in those transactions. And capital gains losses is another area as well. Managing the risks of tax considerations in M&A. As I mentioned, we think it's remarkably important for vendors in particular to undertake a preliminary assessment process with respect to likely tax outcomes and tax risks associated with completing a transaction, and that they should do that before they go out to the marketplace and start entertaining potential target acquirers. So it's really important that they do diligence on themselves and on their own tax position and likely tax risks associated with a particular transaction before they go out to the market. As part of doing that, we've got a sample here of various areas that we think are important to look at. David will no doubt touch on some of these areas when he speaks further. Looking at number 1 and number 2, the historical tax compliance position and the future tax compliance position, that's very, very key from a preliminary diligence perspective, so that vendors in particular can understand any issues that they might not be aware of in their historical taxation compliance landscape that could have a future impact on the due diligence performed by acquirers as part of a transaction. As part of that, in a preliminary assessment, we find it's useful for if there are issues, for clients to at least know what those issues are, so that they don't sit in the category of being unknown unknowns. That can be quite problematic in the context of undertaking a transaction and actually cause issues in completing transactions with acquirers if these things aren't known about. Hence, a preliminary piece of work prior to going to the market that reviews the historical tax compliance of the company, looks at any risks coming out of that with respect to future tax compliance, can be quite useful. Deal structuring is key in the preliminary piece of work. As part of that, we think it's useful, as noted, to review and consider what types of deal structures are likely in consideration of the nature of the business and the nature of the industry in which they operate, and therefore what similar transaction structures are used out there in the marketplace. And as part of that, to reflect on what tax outcomes and tax risks could be inherent in such deal structures, so that they can be pre-planned for, and so that assessments can be made as to what those structuring outcomes will be, or what they could be moderated to be, to minimise tax risks. Part 4, in particular, compliance with state and federal taxation law. Once again, it's a preliminary due diligence piece. It's important to ensure that there aren't any unknown unknowns left on the table so far as historical compliance. Part 5, consideration and earn-out remuneration tax consequences. We find this goes very much hand in hand with deal structuring and the pre-planning around what that could look like. Cross-border tax implications, again, is very much a part of the deal structuring pre-planning process, but also along with earnouts, remuneration tax consequences do become a rolling theme throughout the negotiation of transactions, meaning that it's important to have good advisors along for the M&A transaction ride with you, like David, so that when these types of matters come up and as they're hashed out with potential target acquirers, rolling advice can be received to ensure that the preliminary planning phase actually is moderated to account for any changes that come about in the marketplace when you're negotiating with different acquirers. Tax consolidation considerations, once again, it's worthwhile as a preliminary diligence piece. Expert tax advice in M&A transactions, we find it's just absolutely key. Most good transaction advisors are not good tax people. I'm a glowing example of that. On top of that, most good lawyers that are good at corporate transaction matters are not necessarily good tax advisors. It is such a niche area of expertise, and it's such a material component to transactions insofar as the proceeds that will come out of the transaction, but also the risks of the transaction. It's a massive risk factor in our experience that can really put the wobbles on deals if it's not pre-planned for and not considered with enough thought. And accordingly, we find specialist M&A tax advisors are really, really key. And we're quite demanding of our clients often if they don't have the right expertise in place to get it, because otherwise we find too many components of a transaction end up being in the unknown basket, which doesn't do anyone any favours. Tax consequences of the sale are key. The potential future tax issues that could arise from a transaction are key. Tax risk mitigation is also key. There's a number of different components which are presented here on this slide that I've touched on previously, which are really, really key to assess with the aid of an M&A tax advisor. And on that note, I think it's perfect timing to hand over to David, who will go into some more detail as to these matters.
Great, thanks, Stephen. Very happy to be myself and Nuru partnering with Groves on this. It's a particularly interesting area, and a lot of the partners at Nuru, being ex-corporate, have been on the hard side of transactions and experienced it end to end, and suffered for the issues that come along on the way. So hopefully I can share some of those experiences with everyone today. So on the agenda, I thought what would be particularly useful is to just look at the transaction life cycle end to end. As advisors, you tend to jump in at various points in the life cycle, and certainly from the tax perspective, that's where I'll zoom in on. But I think it's just helpful for everyone to sort of see where it starts from the original thought bubble through to the implementation. And then in terms of the specific issues preparing for sale, how do we structure for sale, as Stephen's been alluding to? What are the tax issues that we've got to consider in doing that, from both the vendor and then thinking about the purchaser's perspectives, due diligence, being prepared, and then once you sort of at the sale stage where you've got some purchasers interested, preparing the due diligence control room, what you need to put into that and how you need to address the various issues that will come up through the due diligence, then documenting the deal, and finally implementation, post-deal issues and management. So just jumping into the transaction life cycle, we see there's quite a few steps in that, around 11 from the initial thought bubble through to implementation. So the initial thought, right, we're going to do a deal here. Let's think about what is that deal? What exactly are you trying to achieve? So you need to be very clear and define the goal and objectives. Are you looking to exit the business altogether? Are you looking just to sell a discrete part of the business or a discrete asset? Or are you looking to raise capital? The answer to those questions will dictate the nature of the deal you've got to do. So very important to be clear up front what you are actually trying to achieve. And once you've done that, understand that the market and the buyers, who's out there and how you should do it. For that, you probably need to engage a investment bank or similar advisor to help scout the market and see who's out there. Next phase is, okay, we're going to do this. Let's get prepared. You see that's got a green ring around it. That means tax has to get involved at that point. So as Stephen alluded to, structuring for sale, depending on what you're trying to achieve, that will dictate the structure and what's the best form of sale for you. That may not always be the same from a purchaser's perspective. Prepare for your due diligence. So what you should do there, do what the purchaser will do. Do your own due diligence as if you're a purchaser. do it like the tax office would do it. Be prepared. Make sure you understand all your various tax issues and risks and deal with it before you go to market. Once ready, go to market. Obviously, point to the right party to help you there. Hopefully, all going well, you'll get some expressions of interest, and then you've got to ascertain, are they really interested? Then we jump into the purchaser due diligence, being prepared for opening up your entire books to the buyers, various buyers, if it's competitive. Finally, then bids are submitted. You've got to analyse them, look at what does that actually yield in terms of a post-tax outcome for you, and select what's the best deal. Once you're done, of course, get the lawyers back in, document the deal, make sure what they're documenting reflects the actual transaction or what you thought the transaction from a tax perspective was going to be. And then lastly, implementation, which is primarily from the purchase perspective, but will have issues for the vendor as well, particularly if it's an asset sale and you're hanging on to the legacy entities. So why does tax really matter in all this? I mean, it has a role to play in every part of those, every phase there, but the particular ones where I highlighted, get the tax wrong, it has a significant impact. Ultimately, when you're trying to sell a business, you want to focus on maximising the post-tax sale proceeds or the gain. So to do that, you don't want unnecessary tax leakages. So to achieve that, you need to structure it optimally for tax purposes if that's feasible. Sometimes commercial drivers will prevent that, but at least you've got to understand the tax costs and leakages if you do structure it in a different way. And when you get into the depths of a transaction, if you try to change the path or the course that you're going down to a different deal structure and to get a better tax outcome, that's always going to aggravate the anti-avoidance rules. Why have you done it other than for a tax outcome? So far better to get on top of these issues and put some daylight between those issues before you actually go out and start negotiating with a purchaser. After you've done your own due diligence issues, clean things up. Get it clean before you go to market. Don't let purchasers find things and be on the back foot, and then you're negotiating away and losing some either indemnities or part of your proceeds of sale. As mentioned, ensure that the deal that the lawyers draft up does align with the tax transaction that you think you're doing. Keep control of the various indemnities and warranties that are going to be given away, so they don't come back and haunt you for many years to come. And yes, lastly, just don't let tax be the issue that kills the deal at the last minute. Seen that happen numerous times, and suddenly you've got a multi-million-dollar tax liability no one knew about until you're at the death of the deal, and that just shouldn't happen if with proper preparation. So structuring for sale, as Stephen alluded to, first question is share sale or asset sale. Now, whilst a number of commercial factors will come into play to dictate what's optimal there, whether you're selling a whole of business, part of a business, or just an asset. If you are selling the whole of the business, generally you're going to want to go for a share sale, because if you do that, you will get better CGT outcomes generally for the individual purchasers. There will often be a tension between the vendor and the purchaser here. From a purchaser's perspective, often an asset sale is better. So you'll have to set it up in a way up front to make the share sale look better if that's what you want to achieve. Otherwise, you'll be on the back foot negotiating against a purchaser who wants an asset sale. So what are the differences on the treatment here, and why is it preferable to do a share sale if you're selling a whole of business? So look at this from sort of the vendor's considerations first, and then we'll have a look at from the purchaser's perspective. So first and foremost, as I mentioned, particularly if it's, or primarily if it's individual shareholders, is CGT. Generally, a disposal will be a capital transaction and give rise to hopefully a capital gain, not a loss. In which case, if you're an individual, if you're fortunate enough to still hold a pre-CGT asset, I'm not sure many of those still exist, there won't be any capital gains tax. Alternatively, as a post-CGT transaction, it will usually be eligible for the 50% CGT discount, so effectively halving the tax on your gain. Most non-residents, if you're a non-resident shareholder, will escape CGT unless some of the underlying assets are real property. And lastly, if you are sitting on unfortunately, some capital losses, it'll be an opportunity to mop up some of those quarantine capital losses you might be sitting on. So definitely the preferred way to go. Although we'll jump in a bit more detail later, just by comparison, if it was an asset sale, if the corporate entity sold assets, the corporate is not eligible for the 50% CGT discount. So they will pay tax at the full corporate rate. They've then got to try and stream out gains through dividends or capital returns. But the net result, in short, generally is you will lose the 50% CGT discount. Some other considerations too, with a preference for a share sale, you get rid of the company, you get rid of the legacy and the history. Yes, you might have to clean it up, offer indemnities and warranties, but you're better off just getting rid of the entity, passing it on to the purchaser if possible. Otherwise, you'll be running off any tax issues in that entity for a number of years to come. So then on to restructuring. Often, depending on the nature of the what you're selling and whether it's a whole of business or part of business, invariably you won't have the ideal current corporate structure. If you've done your job well over the years, maybe you will, but invariably some restructuring may be required to facilitate the sale. So that requires a consideration of a number of things, primarily driven at making sure any restructuring you do for sale does not trigger a tax liability, or at least if it does, minimise the tax liability. That could be income tax, stamp duty, or GST. So I've put together just a little table here for you to take away, but it's just a bit of a prompt for things. This is obviously a complex area and will depend on how you're currently structured, but if you are needing to restructure the group, move entities around or move assets around to facilitate the sales structure, in order to avoid triggering a tax liability, the first thing is, well, are you already a tax consolidated group? If you are, moving things around is relatively simple and will not trigger a tax liability because it's all within the group. If you've not already consolidated, perhaps consolidating is the best first step before you start shifting your things around and getting prepared for sale. Just bear in mind though, forming a tax consolidated group isn't as easy as pressing a button. It is quite complex to implement and can have impacts on cost bases in the group and losses within the group. So just be wary of that. In doing some restructuring, if you're not consolidated as well, there are a number of rollover relief provisions from capital gains tax that you can avail yourself from. So the objective would be, of course, to fall within the requirements to satisfy for those various rollover reliefs. So you'll see I've listed the primary ones when you'll be restructuring. There are some specific ones for small business for restructuring relief. There's also Division 615, which is for share restructures with no ultimate change in economic ownership. That's often if you're, for example, top hatting a group, putting a new entity over the top, which will either be a sale entity or perhaps you're IPOing, it'll be the listing entity. There's share for share exchange relief, and there's demerger relief. So critical that you satisfy the requirements for those if you're doing any of these restructuring steps. Otherwise, you'll find yourself with an unpleasant tax bill. And the sleepers, stamp duty, landholder duty, and GST. If you're transferring various assets around, you may trigger a stamp duty liability. And just bear in mind, stamp duty is a state tax. So the rules do vary a little state to state. And although stamp duty has essentially been abolished for share transfers, it can still apply if there's if the entity you're transferring directly or indirectly has land interests, in which case you can still trigger your landholder duty. Reorganisation relief is not necessarily available either in the case of a asset sale, like you can get with, sorry, a share sale, which you can get with an asset sale. And largely there are some clawback provisions if after availing yourself of any reorganisation relief, you're then subject to a degrouping. So just watch out. Many a time I've seen stamp duty ignored until the last minute, and that can be the deal killer at the end. For GST, it's much simpler with a share sale than a asset sale. You just selling one asset rather than multiple assets. As a result, though, generally a sale of shares won't be subject to GST. It'll be an input tax financial supply. Consequence, though, is costs associated with the transaction that are directly attributable to that. You may not get an input tax credit. So just bear in mind there may be some GST leakage on that reorganisation, and that will depend on the nature of your setup, and for example, whether you've got a 100% recovery rate or a partial recovery rate if you're, for example, a financial institution. So just quickly on the purchaser considerations, if it's a share sale, as mentioned, they buy the company, they buy the corporate history. So that's obviously requires then the purchaser do a full due diligence on the whole company to know what they're actually getting. Bear in mind, as a purchaser, if you are buying an entity that's got a load of tax losses in it, if those tax losses are carrying value on the balance sheet, you probably want to be thinking about discounting them heavily, because they may not be available to you once you buy the entity. First of all, you will trigger a change of ownership. So the only way to avail yourself of the losses would be to satisfy the continuity of business test. And once you start playing around with the business and integrating it with your own, you may not do that. So sometimes it is difficult to access losses in an entity you've acquired. If you're going to bring the entity within your group as well, if you've got a tax consolidated group, often the relative values are such that the so-called available fraction, which is the rate of which you can utilise losses if they are available from a entity that you've acquired, may be so small that effectively the losses are useless. Had one recent one, I think they can bring it in at sort of 0.02% or something. So it's going to take 100 years to access and use those losses. From the purchase perspective, the stamp duty, landholder duty is obviously paramount. They're the party acquiring, so therefore any stamp duty that does arise, that they'll be the ones paying, not the vendor. Generally, purchase of shares produce a better result than an asset purchase, primarily because no duty does apply to the acquisition of shares unless the company directly or indirectly holds land. Should there be a land interest, then landholder duties can apply up to 5.75%. It's pretty expensive and a large tax leakage to a transaction if you're going to lose that. And bear in mind too that that land includes any fixtures to the land, which, for example, I think there's been a recent one around wind farms and things. Are the turbines actually fixed to the land or not. I think New South Wales has a different view to Victoria, so bear in mind that there is some risk around those sorts of things. Common trap, there is landholder duty is payable on the gross value of the land, including the fixtures, not the net value of the company. I've seen some people trip up on that. And lastly, another common trap, Queensland. Queenslanders have to be different. They have a trust look-through regime for private trusts, so you will look through to the underlying assets even if you buy the trust there. So watch out for that. The purchaser side on GST, similarly, if you're buying the shares, it will be acquisition of input tax supply. You'll have the same issue where costs directly relating to that, you may not be eligible for a input tax credit, so that could come at a cost. That might depend on whether you breach the financial acquisition threshold. The purchase of shares, giving the buyer a controlling interest, does not result in a transfer of the underlying business as a going concern. It's so the going concern exemption doesn't apply in this case. Similarly, for GST purposes, such purchase doesn't result in a separate supply of real property. When you're buying the shares, you don't look through like you, for example, would for stamp duty. And just bear in mind, GST treatment of costs relating to borrowings will be generally to finance purchase of shares. You may not get an input tax credit for any GST imposed on that. So now just jumping to an asset sale. From the vendor's perspective, as mentioned, that results in a sale by the company of all the various assets. So if that triggers a capital gain, no CGT, 50% CGT discount. So that does result in an incremental cost potentially. However, if the company happens to have losses, then that you may think that's a good thing. You can shelter and those gains with the losses you have in the entity, rather than those potential losses potentially being lost later in any event. Just bear in mind, even if you do that, it can be tricky to then extract the gain or the cash proceeds out of the company. For example, if you do it by way of dividend and you haven't paid tax, you'll have to do that as an unfranked dividend. If you do a capital return, then that will erode the cost base of the shareholders' shares. So ultimately will result in a potentially a large capital gain down the track for them. Purchases consideration, asset sales, great. You don't get the corporate history. Makes life a lot simpler from that perspective. Simpler or more complex though. It might be simpler in that you're not inheriting the corporate history, but you are buying a whole lot of assets and generally being having a whole lot of liabilities and that you're assuming as well, including employees and everything else that goes with it. So that can be far more complex to document and ultimately integrate into your own system. So just bear in mind. So perhaps simpler from a tax perspective, but not from a legal perspective. Stamp duty, great. You're not acquiring any historical issues in the entity from when the vendor restructured and caused unknown issues. The unknown unknowns. Bear in mind your duty on intangible business assets does still exist in some states. Queensland, WA, Northern Territory still imposed on goodwill and IP at up to 6%. So you need to find out where the IP is situated, and for goodwill, something that's often missed is you've got to attribute your goodwill to the various states, and that will generally be based on where the customers sit. So you've got to do an analysis on revenue by customer and divide it up across the various states to work out what liability will arise in those old-fashioned states still imposing stamp duty on goodwill. GST, from the purchaser's perspective, Essentially, if they're buying the various assets, you just need to look at the nature of those assets and will you get a input tax credit for any GST imposed on that. You need to consider the potential effect of any GST gross up clauses that may be in the sale agreement, so that will be passed on to you through a gross up mechanism. Having regard to all that, the treatment of any inputs that you've acquired and whether you'll get a full credit on those various inputs. Right, so once you've got through all that and you understand all the various different costs and things associated with it, and you've probably concluded as a vendor you'd rather do a share sale and get rid of the legacy. Next step, you've got to do due diligence on yourself. The last thing you want to do is discover tax issues or have the purchaser discover tax issues down the track and erode your negotiating position. So now's the time before you get to then to see if you've got any skeletons in the closet. So the way to really approach this, I think, is first of all, do a full risk review on yourself, similar to how either the ATO would do it and how the purchaser would do it, which should be very similar. So you need to go back to the time limits, usually 4 years, look at all your tax filings, your tax issues, and anything that's within the time limit. Make sure all your tax filings are up to date. And if you do discover any issues or risks, you've got to work out how to remediate them. If you, ideally you do remediate them, that may involve going to the ATO and fessing up, doing a voluntary disclosure on a number of items. If it's, you've just made some routine mistakes. If it's other matters you don't want to go to the ATO on, well, that's a decision you have to make, but make sure you've fully evaluated the amount involved and the level of risk involved so that you're ahead of the curve when the purchaser discovers it. So you can factor that in appropriately to, one, how much discount potentially on the purchase price you may give up for passing this issue on to the purchaser, and how any indemnities and warranties around it may be structured. Ideally, you shouldn't have to do a lot of this if you're doing your tax job properly and running your tax function appropriately. Everything should be up to date, squeaky clean. You'll have a tax governance framework in place. You'll be managing your tax risks on a contemporaneous basis, and you won't have any skeletons in the closet you're not aware of. Doesn't usually happen that way, sadly, but that is the way to do it. But yeah, if there's any message here, then stay ahead of the curve, and you're always sale ready then. So you've resolved everything, and you're now prepared to fess up and put it all in the due diligence control room for the purchaser to go through. Don't underestimate the difficulties in sort of putting all the data together. If you've done your own vendor due diligence properly, it'll all be there, of course, but invariably you haven't by the time a sale comes on, and it will take a lot of time to pull all the data together, review the data. Don't just sort of drop in the tax returns and the tax return work papers and every tax opinion or a bit of advice you've got for the last 4 years. You got to review all of it. You got to know what's in there. You got to make sure you're happy with the tax return work papers being presented the way you've got them on file, or whether you need to actually tidy them up. I've been through this a few times with clients, and they say, here it all is, and I say, great, I'll just have a quick look, and the tax return work papers and the taxable income, for starters, don't even match what's on the tax return. Oh yes, we had to make a few changes at the last minute. Well, okay, you've got to update the tax return work papers. So yeah, basic stuff. but make sure what you've got all ties in, all reconciles, and all makes sense. Any opinions that you may have, might be very selective in what you'll disclose. So treat it a bit like if the ATO came in, you'd be selective in what you may disclose or what you may call for legal privilege on, and just manage it appropriately. To give you an idea, and I'm not going to touch on this now, but it'll be attached as an appendix to the presentation that'll be circulated around on completion of this. I have put there a sort of fairly broad but generic checklist for preparing for due diligence, the sort of information that will be asked for and what you'll need to prepare. And I've done that both from an asset sale and a share sale perspective. So if you're considering a sale, have a look and see what you need to start gathering and reviewing. And yeah, as I mentioned, don't underestimate the time to put this together. And just sort of back to, even if you're a vendor doing your own vendor due diligence and you are trying to remediate issues with the ATO before going to market, don't underestimate the time. Yeah, I've had one fairly recent experience. I put the transaction back 2.5 years, just trying to resolve these issues, by which case, of course, the market's moved and things have changed. So it is time consuming. The ATO doesn't move at the pace we would ever like them to move at, nor necessarily the direction. Documenting the deal, as mentioned, very important to ensure that what the lawyers document is what both the commercial people think they're documenting and what the tax people wanted them to document. Tax must be involved. Don't let the lawyers just run with this and end up executing a deal that doesn't reflect what anyone thought was the deal. Essential you're involved right from the get-go on the documentation. Bad drafting, as I've said, there are two, generally has bad consequences, primarily for the vendor. You might want to consider how it's being done in terms of earn-out arrangements, etc., and the impact that will have on the CGT. You'll need to be close to whether conditions that go into the contract are condition precedent or subsequent, because that has a timing on when the CGT event occurs and the liability arises. Mention if anything you're doing in this, there's been CGT rollovers done previously, make sure you're not tripping any of those up. And lastly, tax is transaction focused. So if there's, the way the deal's being documented actually results in, sub-transactions within the transaction, they will likely have a different tax consequence. So just, stay close to it and be involved. It's a tedious, boring process. But the good part is usually the lawyers work from 10 p.m. till 7 a.m. and then you come in and you look at what they've done overnight. So it's you're on the better side of the process, having experienced it a few times. Yeah, and then just managing the identified risks in the documentation. Really, what that comes down to is you've got some issues that are being passed on. Be careful on the indemnities and warranties. Invariably the purchaser will go the kitchen sink approach. They'll throw every generic indemnity and warranty in the documentation. It's then up to you to work out what you want to try and negotiate away or pare back. Just to round out on that, what is the difference sort of between the two and why have you got to be careful? Warranty is really warranting certain facts. For example, you have lodged all your tax returns, everything's up to date, etc. Indemnities are where things don't go the way they're meant to go, and you get the purchaser coming back with their handout to say they want to be compensated for the extra tax liability that they're up for. And just you've got to factor in, how is that going to be managed too? For example, if the purchaser undergoes a tax audit, issues come up, who manages that? You probably will want to have the right to take over the management of those issues, given you're ultimately under the indemnity going to be the one that has to cough up and pay over the money. So in short on these, be careful. Be careful what you give away. But on the other hand, don't get bogged down in not giving up or not accepting certain indemnities and warranties if actually they have no cost. So make sure you understand the potential ramifications for each one and be prepared to give up on the arguments on some and on what to sort of dig your heels in on the others, on the ones that really count for you. And just bearing in mind with those, how do they work? If you do have an indemnity payment, that often will be structured as a purchase price adjustment. That'll have CGT implications for the vendor. They'll have to go back and amend their prior tax returns, and for the purchaser, their cost base will change as a result of anything happening there. Make sure you stay focused on document retention and records on any issues that you think may come up. I did have some experience with a transaction where there was a very significant tax risk that went with the deal, and we sort of spent a year of our lives going around gathering all the evidence and data and everything we could find to support the tax position should it have ever been challenged. Because once it's moved on, you've sold the entity, all the corporate memory, the history goes, and that never works out well with the ATO, resulting in you'll lose your position with the ATO, and therefore the indemnity will be enforced, and suddenly the vendor's lost a lot of money. So be prepared. Make sure if you think there are significant risks, you have them well documented and prepared until the time limits hopefully lapse and the issue goes away. So the deal's done post acquisition. Sadly, the hard work's about to start now, primarily for the purchaser, but sometimes for the vendor but for the purchaser on implementation. That is tricky. Bear in mind any stamp duty liabilities that have arisen as a result of the purchase, tax compliance. You'll have to integrate it all within your own corporate group, and perhaps a tax consolidated group. The issues there, you'll have to notify the ATO of that. If you're joining a tax consolidated group, you'll have to prepare and accession deeds to tax sharing agreements, and you'll have to do various other registrations and things. You'll have to update your tax governance framework. There's a lot of work on the purchaser side, so it goes on. And then lastly, entity reduction. Ultimately, if you've bought a whole lot of new entities across, you probably don't need them all. You want to do a streamlining exercise to reduce cost. That'll always, of course, brings tax issues with it as well. Lastly, as mentioned, tax consolidations. Bringing the new entity into the group is a very tedious and complex exercise in bringing into your tax consolidated group. Don't underestimate the work involved there. And then, as mentioned, the tax consequences of aligning your operating legal structures, and don't forget, stamp duty can also be an issue that arises there if you're transferring assets around. And I think I've probably said enough, Stephen. Q&A.
Q&A. I can see one question. Thanks, David. That was really, really informative. I can see one question here from Simon Hall to you. David, do you know if stamp duty applies to goodwill in each state if there is no land or assets fixed to land located in the state when the transaction occurs?
I'm not a stamp duty expert, but I can say it can apply in each state, but not necessarily on the land. It can apply on goodwill.
Yep.
The goodwill needs to be carved up and split over the states, generally be based on client and client revenues in those various states.
Yes.
As for landholder duty, if that arises, that will arise in the state where the land is situated.
Fantastic. Thank you very much, David, for being so informative. I think we'll wrap it up there, and thanks to everybody for attending. I think it's been fantastic, and some really good insights today. And thanks very much for your time, everyone. We'll leave it there.
Thank you.